Is 2026 the year to buy property in the UK? Everything you need to know before you decide. Right now, there are two types of people. Those waiting, thinking I'll buy when things feel safer, and those quietly moving, locking in deals while everyone else hesitates. So, which one is right? Because in 2026, the UK property market isn't booming, but it's not totally crashing either. It's something far more confusing, and that's exactly why so many people feel stuck. So in this video, we're going to break it down properly. First, what's actually happening to house prices, then whether you can realistically afford to buy, the true cost of buying, whether renting might actually be better, if property is still worth it, the property tax rules you need to know, and finally, the best strategy going forward. By the end, you'll know exactly what decision makes sense for you. Let's begin. First, what's actually happening to UK house prices in 2026? Let's start with the big picture, because this is where most people get confused. You'll hear headlines saying, prices are rising again, or a crash is coming. But the reality sits somewhere in the middle. Yes, prices have edged up slightly on paper, but when you factor in inflation, property values have actually fallen in real terms over the past couple of years. This is what people call a silent correction. No dramatic crash, no panic selling, but your money simply doesn't go as far as it used to. At the same time, the UK is no longer moving as one market. Northern regions are seeing stronger growth in rents, while London and parts of the south have slowed or declined. So the key takeaway is this: it's no longer about timing the market, it's about understanding where the opportunity actually is. But here's where it gets more interesting, because this shift is also changing how investors think about returns. In the past, people relied heavily on capital growth, buy in London, wait, and let rising prices do the work. But in 2026, that strategy is far less reliable. Now, returns are coming from a combination of factors: rental demand, local affordability, employment growth, and how desirable the area actually is to live in. For example, a £180,000 property in a strong northern city growing at 4% per year could outperform a £450,000 property growing at 1%, even though the more expensive property feels like the better investment. And this is where many people go wrong. They focus on price instead of performance. Another key shift is this: because the market has already cooled, buyers now have more negotiating power. Properties are taking longer to sell. Sellers are more open to offers, and discounts are more common than they were just a few years ago. So while it might not feel like the perfect time to buy, it may actually be one of the more balanced conditions we've seen in years. Not a boom, not a crash, but a market where disciplined buyers can make better decisions. And that's the real opportunity in 2026. Second thing we're going to talk about is, can you actually afford to buy in 2026? Now that you understand what's happening in the market, let's bring it back to you. Because the real question isn't, is it a good time to buy? It's, is it a good time for me to buy? And that comes down to affordability. But here's the mistake most people make. They only look at one number, usually the monthly mortgage. In reality, there are three separate hurdles. First, the deposit. If the average property is around £270,000, a 10% deposit is £27,000. But in reality, it's never just the deposit. You've got stamp duty, legal fees, survey costs, moving costs, and a bit of buffer so you're not left with zero in your account. So suddenly, you're not saving £27,000, you're closer to £35,000 to £40,000. And this is where most people get stuck, not because they can't afford the monthly payment, but because they can't get over that initial hurdle. Second, mortgage affordability. Rates are still higher than what many people got used to over the past decade. So lenders are more cautious. They don't just look at what you earn, they look at what you spend, your debts, and stress test your repayments. Which means, you might feel like you can afford a £300,000 property, but the bank might only lend you enough for £240,000. And that gap is where expectations need to adjust. Third, your financial resilience. This is the one most people ignore. Ask yourself, if interest rates stayed where they are, or even nudged up slightly, would you still feel comfortable? If the boiler broke next month, could you deal with it? If your circumstances changed, would you still be okay? Because property isn't just about getting the keys, it's about holding the property through real life. And real life is rarely smooth, so the real question isn't, can I just about afford this? It's, can I afford this without it becoming stressful? Because the people who do well in property aren't the ones who stretch the most. They're the ones who give themselves margin, and that's what keeps them in the game long enough to actually benefit from it. Third topic is about the real cost of buying a house. Now let's talk about something most people underestimate: the true cost of buying. Because the deposit is just step one, and this is where a lot of buyers get caught out. They budget for the deposit, but not for everything else that comes with it. Let's break it down. First, stamp duty. As of the 2026 to 27 tax year, most buyers will now pay stamp duty again due to lower thresholds. For example, if you buy a £300,000 property, you could be paying around £5,000 in stamp duty. That's money gone immediately. It doesn't increase your property value. It doesn't reduce your mortgage. It's just the cost of getting in. Second, legal and purchase costs. Solicitors, surveys, searches, typically around £1,500 to £3,000, but it can easily creep higher depending on the property. For example, a full structural survey on an older property could cost £600 to £1,000 alone. And if issues come up, you may need further inspections or renegotiate entirely. Third, maintenance. This is the one people massively underestimate. The moment you own the property, you become responsible for everything. Let's say your boiler breaks, that's £2,000 to £3,000. Roof repairs? Around £5,000. Electrical issues? Easily £1,000. And these aren't rare events, they're part of owning property long term. Now here's the key point most people miss. These costs do not build wealth. They are sunk costs. They don't increase your equity. They don't boost your return. They simply allow you to maintain the asset. So if you ignore them when calculating your return, you'll think property is performing better than it actually is. And that's where unrealistic expectations come from. Fourth topic. Renting versus buying in 2026. Which one actually wins? Now this is where things get really interesting. Because once you understand the real costs, you start to question a big assumption. Is buying always better than renting? Let's break it down with a simple example. Imagine this. You buy a £300,000 property, you put down £30,000, and your mortgage is around £1,500 per month. Sounds like you're building wealth, right? But here's what's actually happening early on. Only a portion of that payment reduces your loan. Let's say around £400 per month goes towards equity. The remaining £1,100, that's interest. Now compare that to renting the same property at £1,200 per month. At first glance, buying still looks better. But now let's include the full picture. Your £30,000 deposit is tied up in the property instead of being invested elsewhere. Let's say that £30,000 could earn 5% annually. That's £1,500 per year in potential returns you're giving up. Now add stamp duty, around £5,000, legal fees, say £2,000, maintenance, maybe £2,000 a year. Suddenly, that extra cost of renting doesn't look so bad. In fact, in the short term, renting can actually be cheaper overall. So here's the practical rule. If you're staying for less than 5 to 7 years, renting can often come out ahead financially because you haven't held the property long enough to recover those upfront costs. But if you're staying long term, buying usually wins because over time, your mortgage reduces, your rent would have increased, and eventually, you own the property outright. So this isn't about picking sides. It's about understanding your timeline, because the right decision is the one that fits your situation. So, after all of that, the fifth topic we have, is property still worth it in 2026? You might be wondering, is property even worth it anymore? Because returns feel lower. Some landlords are exiting, and it's definitely more complex than before. But here's the truth. Property hasn't stopped working. It's just changed. It no longer works well as a simple income play, but it still works extremely well as a long-term wealth strategy. Because of leverage, using borrowed money, rental income, supporting the asset. Inflation, reducing your debt over time. So instead of thinking, how much monthly income will this give me? The better question is, what will this be worth in 10 or 20 years? But here's something even more important. Most people underestimate how powerful time is in property. For example, if a property grows at just 3% per year, over 20 years, that's nearly doubling in value. Now combine that with a tenant paying down your mortgage, and suddenly, what felt like a slow investment becomes a very powerful one. The problem is, most people expect property to feel exciting in the short term, but in reality, the biggest gains come quietly. So if you go into property expecting quick wins, you'll probably be disappointed. But if you treat it like a long-term system, that's when it starts to make sense. Sixth topic. Property tax in 2026 to 27. What you need to know. Now let's talk about the part that can quietly reduce your profits. Tax. And this is where a lot of investors go wrong. Not because they're doing anything illegal, but because they don't fully understand how the system works. Number 1. Mortgage interest rules. If you own property personally, you don't get full tax relief on mortgage interest. Instead, you receive a basic rate tax credit. So if you're a higher rate taxpayer, you could be paying tax on income that you haven't really kept. Number 2. Limited company ownership. Companies can deduct full mortgage interest and pay corporation tax up to 25%, which sounds more efficient. But here's the catch. If you want to take that money out personally, you'll likely pay dividend tax on top. So it's not about what's best, it's about what fits your long-term plan. Are you reinvesting profits or living off them? Number 3. Capital gains tax. If you sell a property, basic rate taxpayers, 18%, higher rate taxpayers, 24%, and importantly, you now need to report and pay within 60 days of completion. Miss that, and you could face penalties. But here's the bigger lesson. Tax isn't something you deal with later. It's something you plan for before you buy, because choosing the wrong structure can cost you thousands over time, and fixing it later often triggers more tax, not less. Now finally, strategy. The 7th topic, the best property strategy in 2026, because this is what ties everything together. Step 1. Know your goal. Are you building long-term wealth, monthly income, or trying to scale quickly? Because each one leads to a completely different approach. Step 2. Choose the right approach. Buy-to-let. Simple, steady. House in multiple occupations, or HMOs. Higher income, more management. Refurbs. Higher return, more involvement. There's no perfect option. Only what fits your time, risk tolerance, and experience. Step 3. Choose the right location. This matters more than ever. The UK is no longer one market. Look for strong demand, good transport links and areas people actually want to live. Because long-term growth comes from real demand, not just low prices. Step 4. Focus on total return, not just yield, because income plus growth is what builds real wealth over time. But here's something most people overlook. The best investors don't just buy good deals. They build repeatable systems. They know what type of property they're looking for, what numbers work for them, and when to walk away. For example, looking at 20 properties to buy one great one, instead of buying the first decent deal they see. Because in 2026, there are more opportunities, but also more ways to get it wrong. So the real advantage isn't speed, it's discipline. And that's what separates people who build portfolios from those who just buy one property and stop. So, is 2026 the year to buy property? It depends. If you understand the numbers, plan properly, and think long-term, then yes, it can be a strong opportunity. But if you rush in, ignore costs, or get the structure wrong, it can become expensive very quickly. So take your time, focus on the fundamentals, and make decisions based on facts, not fear. And just to mention, this video is designed to give you a general understanding of how things work in the UK right now. Your own situation may be very different. So before making any big decisions, it's always a good idea to speak with an accounting professional or property professional who can guide you based on your personal circumstances. And if you want clear, UK-focused guidance on tax, property, and building wealth properly, make sure to subscribe, because understanding how the system works is how you keep more of what you earn.